Imagine a ticking clock hovering, like right over the trading floor of the New York Stock Exchange.
Oh, yeah.
Just this massive digital countdown timer, and it's set to expire at exactly 10:05 a.m. Eastern Time on Monday, April 6th.
Right.
If that clock hits zero, roughly 8% of the world's daily oil supply could just poof, permanently vanish from the global market.
Which is an unthinkable amount of energy.
Exactly. Welcome to the deep dive. If you're tracking the markets right now, you already know this first week of April 2026 has been just a historic, violent collision of kinetic warfare and global finance.
Yeah, violent is the right word.
Our mission today is to take this absolute avalanche of recent news feeds, the financial reports, the macro data releases, and even some of the latest YouTube analysis, and synthesize it all for you. We're going to map out the actual mechanics behind the chaos.
Because the cross-currents operating right now between the military action, the corporate maneuvering, and macroeconomic policy, and they're creating this web that requires us to look at the entire board simultaneously. You really cannot understand the tech sector sell-off without first understanding the shipping lanes in the Persian Gulf.
Okay, let's unpack this. But before we get into the actual mechanics of this week, so we have to start with the immediate horizon. Like, what is happening right this very second over the weekend? Because it really dictates the gravity of everything else.
Yeah, everything flows from this.
And the biggest driver of that gravity is that 10:05 a.m. Monday deadline we just talked about. President Trump issued a 48-hour warning to Iran to open the Strait of Hormuz.
And the timing of that is it's almost cinematic.
Right. I mean, the U.S. stock market opens at 9:30 a.m. after a 3-day holiday weekend. So this deadline expires exactly 35 minutes into the trading session.
It creates an absolute pressure cooker for institutional capital.
Oh, I bet.
When that opening bell rings, every algorithm, every hedge fund manager, every derivatives desk, they will be holding their collective breath for those 35 minutes.
Just waiting.
Exactly. Because a vague threat of escalation is one thing, but a highly specific, down-to-the-minute deadline means the market will instantly price in a binary outcome.
Meaning it goes one of two ways.
Right. If 10:05 a.m. passes without verifiable compliance regarding the strait, the baseline assumption models instantly shift to sustained, severe military escalation.
And while that clock ticks down toward Monday morning, the energy markets are already scrambling today, Sunday, April 5th.
Yeah, the OPEC Plus emergency meeting.
Right, happening right now. The big 8 producers are sitting at a table trying to figure out how to stop the bleeding.
And their dilemma is mathematically brutal.
How so?
Well, going into this weekend, OPEC Plus was scheduled to implement a routine, modest production increase of 206,000 barrels per day.
Okay, which sounds like a lot to a normal person.
Right, but in a stable macroeconomic environment, that's just a standard calibration to match seasonal demand. It's tiny.
Yeah.
But the functional closure of the Strait of Hormuz has instantly removed roughly 8 million barrels per day of supply from the global network.
Wow. So to contextualize that for you, 8 million barrels is close to 8% of total daily global consumption just vanishing overnight. So a 206,000 barrel increase is basically like throwing a cup of water on a house fire.
That's exactly what it is. And it forces OPEC Plus to abandon their long-term strategy.
So what are their options?
They have to decide right now whether to stick to their established quotas and just watch global oil prices hyperinflate, which, eventually destroys demand by causing a global recession, or they completely abandon their quotas and order every member state with spare capacity to pump as much physical crude as their wellheads can handle.
Just open the floodgates.
If they even can.
Right. And this isn't just a theoretical supply squeeze. I mean, the kinetic military flashpoints hitting the newswires are relentless.
Yeah, the weekend feed was heavy.
Over the weekend, the feed lit up with the rescue of missing U.S. F-15E pilots following a heavy firefight inside Iran.
Which required the deployment of U.S. Special Forces on the ground.
Right. We have footage of an Iranian drone striking a Bapco energy facility in Bahrain, visibly setting a storage tank on fire.
That imagery really spooked the market.
And then the headline that terrifies algorithmic trading bots more than anything else, the IAEA, the UN's international nuclear watchdog, received notice of a projectile hitting near the Bushehr nuclear facility.
A near miss at a nuclear plant fundamentally changes the risk premium of the entire region.
Oh, absolutely.
When an automated trading system scrapes a Bloomberg terminal and sees the words projectile and nuclear facility in the exact same sentence, it's programmed to immediately dump risk assets and buy safe haven currencies.
It's just a programmed flight to safety. No human thought required.
Exactly.
But amidst all of this actual warfare, what really fascinates me is the corporate news feed.
Yeah, the everyday economy.
Right. The underlying economy is still trying to operate, but you can see the metal buckling under the stress.
For sure.
Look at these three seemingly disconnected stories from the weekend feed. First, Amazon announces a 3.5% fuel and logistics surcharge for third-party sellers in the U.S. and Canada, going into effect April 17th.
Okay.
Second, McDonald's announces a brand new under $3 menu to attract cost-conscious consumers.
Very telling.
And third, meanwhile, in China, DeepSeek is preparing to launch its V4 AI model, threatening the global semiconductor race.
We really need to look closely at the mechanics of those first two stories, because they're the physical manifestation of the geopolitical crisis filtering down to the retail level.
Wait, let me see if I can connect the dots here.
Go for it.
So if the Strait of Hormuz is closed, oil spikes.
Right.
Tankers have to reroute, meaning they burn more fuel. That means diesel prices skyrocket.
Exactly.
And Amazon cannot magically absorb a doubling of shipping costs, so they pass it on to their third-party sellers with that 3.5% surcharge.
Which is significant for small businesses.
Right, because a third-party seller operating on, like, a razor-thin 10% margin can't absorb that either, so they raise the price of the phone case or the blender they're selling.
Yep.
So suddenly, the everyday consumer is completely tapped out by this imported inflation, which is exactly why they can no longer afford a $15 fast food meal, forcing them straight into McDonald's new $3 menu. Is that the loop?
That is the exact mechanism of a supply-side inflation shock.
It's wild to think about it that way.
It really is. The drone strike in Bahrain ultimately dictates the price and availability of a burger in Chicago.
Wow.
The consumer's discretionary income is just destroyed by the energy sector. And regarding your third point, the DeepSeek AI launch in China,
Yeah.
that proves that the technological Cold War does not pause for a hot war in the Middle East.
If anything, it probably accelerates it.
Exactly. It exacerbates the strain. It makes the competition for physical resources like advanced semiconductors and the massive electrical power required to run these AI models even more fiercely contested in an already constrained global supply chain.
It really pulls the curtain back on how fragile the globalized economy actually is.
We're watching the dominoes fall in real time.
We really are. So now that we understand the absolute urgency of this weekend, we have to rewind the tape to Monday, March 30th.
The start of the trading week.
Right. We need to trace how the market digested this escalating pressure over the last few days.
Well, Monday really established a pervasive sense of dread across the equities market.
It was a genuine correction scare. The week began with the S&P 500 falling 0.4% to close at 6,343.72. Now, that specific number matters because it means the index was flirting with a 10% drop from its record high back in January 2026.
And a 10% drop is the textbook definition of a market correction.
Right. The psychology shifts from buying the dip to capital preservation.
Exactly. And the entire drop was driven by the realization that 20% to 30% of global crude flows moving through the strait were effectively choked off.
The market was pricing in a prolonged strangulation.
But the psychology of markets is inherently volatile, right? Which often leads to massive overcorrections.
Which perfectly explains Tuesday and Wednesday.
Oh, yeah.
The sources describe a massive, violent V-shaped relief rally. The S&P 500 surged 2.9%, and the Nasdaq 100 jumped an incredible 3.4%.
Huge moves.
Just to give you, the listener, some context, that was the best single daily performance for those indices since May 2025.
Unbelievable.
If you just looked at the chart, you would assume a comprehensive peace treaty was signed.
Right. But this is a crucial lesson in market mechanics. That rally was not built on fundamental economic improvement.
No.
Not at all. It was built on aggressive short covering, triggered by false hope.
Okay, let's break down short covering.
Sure.
This means investors, mostly hedge funds, who had actively bet that the market would go down, were suddenly forced to buy back the stocks they borrowed just to limit their losses.
Yes,
Right?
precisely. In a short sale, you borrow shares and sell them, hoping to buy them back later at a lower price to return to the lender, and you pocket the difference.
Right.
But early in the week, rumors and whispers leaked from the White House, suggesting a diplomatic off-ramp was imminent.
Okay.
So when algorithms catch wind of a potential ceasefire, the market starts to tick up. And the hedge funds that are heavily short suddenly see their positions losing millions of dollars by the second.
Because the price is going up, not down.
Exactly. So to stop the bleeding, they are forced to buy the underlying stock to close their positions.
Which ironically makes the price go up even more.
Exactly. This forced buying triggers more price increases, forcing other short sellers to buy, creating an explosive upward feedback loop.
Wow.
It was a classic dead cat bounce, fueled entirely by the mechanics of leverage, not reality.
And reality arrived with a vengeance on Wednesday night.
It certainly did.
President Trump delivered a primetime address to the nation, and it took a sledgehammer to that fragile optimism.
Yeah, that changed everything.
He stated that the U.S. had nearly achieved its objectives, which sounds positive on the surface.
Right.
But then he offered absolutely no definitive timeline for withdrawal. Worse, for the market's perspective at least, he threatened to hit Iran extremely hard for another 2 to 3 weeks and specifically outlined plans to strike power infrastructure.
And crucially, the sources note that Iran rejected a 48-hour ceasefire offer.
So the diplomatic off-ramp just vanished.
Instantly.
Yeah.
The narrative pivoted from brokered peace to protracted infrastructure destruction.
And the reaction at the next market open was terrifying. The S&P 500 erased roughly $830 billion in value immediately.
It's gone.
Just wiped out. It's difficult for the human brain to comprehend $830 billion evaporating in the time it takes to drink a cup of coffee.
Yeah.
Where did that money actually go?
Well, it doesn't go anywhere. It simply ceases to exist.
Wait, really?
Yeah. Market capitalization is just the current share price multiplied by the number of outstanding shares. So when the perceived value of future earnings drops due to the realization of a prolonged war, the share price drops. That $830 billion is just the collective realization that corporate profits over the next decade will be severely damaged by the cost of this conflict.
It's just a mass repricing of the future.
Exactly.
Which brings us to the macroeconomic data drop on Friday.
Oh, Friday.
And this is where the plot goes from chaotic to deeply complex. So Friday was Good Friday. The equity markets were closed for the holiday. But the government still released the March jobs report. And the numbers completely rewrote the economic narrative for the quarter.
It was a massive shock to the consensus models.
Let's look at the actual numbers. Non-farm payrolls grew by a staggering 178,000 jobs.
Which is huge.
The consensus expectation on Wall Street was just 60,000. They missed the mark by nearly triple.
Almost triple, yeah.
Unemployment fell to 4.3%.
Right.
Now, there was a significant downward revision for February, a loss of 133,000 jobs. But that March explosion was undeniably hot.
And paired with that, we got the ISM Manufacturing Prices Paid Index.
Right.
And the ISM Index is critical. It tracks what purchasing managers at massive manufacturing companies are actually paying for raw materials. It's a pure forward-looking indicator of physical inflation.
And it screamed up to 78.3. That's an increase of 7.8 points in a single month, showing severe, widespread raw material inflation hitting the manufacturing sector.
Right. So when you look at the labor data and the ISM data together, it creates a deeply problematic scenario for the stock market.
Okay, wait. Let's look at this like a normal person for a second.
Okay.
The economy is adding nearly triple the expected jobs. Unemployment is dropping. Manufacturers are buying materials.
Yeah.
If the economy is physically resilient, why did the futures market, which was open while the stock market was closed, drop 0.2% on this news? Shouldn't a strong employed consumer base be the ultimate good news for the stock market?
In a vacuum, a strong labor market is positive.
Right.
But we are not in a vacuum. Wall Street is currently caught in a vice grip known as the hawk trap.
A hawk trap. I assume that means the Federal Reserve is trapped.
Exactly.
For the last year, the market has been rallying on the assumption that the Fed was going to cut interest rates, right? They want to cut rates to keep the stock market happy, but they are forced to stay hawkish, meaning keeping rates high because the war is making oil too expensive. And now this jobs report shows people have too much money to spend. Are they just completely stuck?
You've identified the exact mechanism of the trap. The Federal Reserve operates on a dual mandate: maintain maximum employment and keep prices stable.
Right.
Wall Street valuations, especially in the technology sector, are highly dependent on the cost of borrowing money. Lower interest rates increase the present value of future cash flows.
So tech loves low rates.
Loves them. The market was banking on rate cuts. But the Fed can only cut rates if the economy is cooling down and inflation is defeated.
And this data proves the exact opposite.
Exactly. The March jobs report shows a labor market running incredibly hot. 178,000 new paychecks means 178,000 more people spending money in the economy.
Driving up prices.
Right. And at the exact same time, the ISM index and the $110 crude oil price guarantee that the supply side of the economy is experiencing massive inflation.
Oh, man.
If the Fed cuts interest rates in this environment, it would be akin to pouring jet fuel on an inflation fire. The strong jobs report was disastrous for Wall Street because it permanently removed the possibility of a near-term rate cut.
It's actually worse than just removing the cut. The sources indicate that Fed funds futures, the derivatives market, where traders bet on the Fed's next move, are actually beginning to price in the possibility of rate hikes for 2026.
Which is huge. Going from an expectation of multiple rate cuts to the realization of potential rate hikes is a foundational paradigm shift.
A complete 180.
Exactly. It means the higher-for-longer interest rate environment is no longer a temporary phase to be endured. It is the new structural reality. Every valuation model on Wall Street has to be aggressively recalibrated for a higher cost of capital.
You know, when you see macro data totally invert market expectations like this, and you watch $830 billion evaporate based on the tone of a single primetime address, it really makes you realize how vital it is to stay informed.
Absolutely.
Because in a market where geopolitical events are shifting billions of dollars overnight, you need a reliable guide to help you cut through the noise every single week.
Yeah, the noise is deafening right now.
So, if you are finding this breakdown helpful, please hit that subscribe button, leave a like, or drop a comment on our YouTube channel. Because understanding the difference between a dead cat bounce and a structural shift is literally the difference between surviving this market and getting wiped out by it.
Survival in this environment absolutely depends on looking beneath the surface of the broad index numbers.
Which brings us perfectly to the next phase of our outline. We've established the macro gridlock, the war, the inflation, the trapped Federal Reserve.
Right.
Now we need to look at how this pressure is fracturing the market beneath the surface. We're seeing a violent divergence in idiosyncratic stock movers.
Yeah, a massive split.
Some companies are absolutely dying in this war economy, while others are finding massive opportunities. Let's start with the heavyweights, the tech megacaps. The ultimate question for retail investors is, do we buy the dip?
To answer that, we have to look at the mechanics of their current valuations.
Let's look at Microsoft, down 23% year to date. For a company valued in the trillions, a 23% haircut is a massive destruction of wealth. It's currently trading at 22.5 times forward earnings.
We need to define forward earnings for a second.
Yeah, please.
The forward PE ratio is the current stock price divided by the estimated earnings per share over the next 12 months. It's essentially how much you're paying today for a dollar of profit tomorrow.
Okay, got it.
A 22.5 forward PE is a steep discount compared to Microsoft's 10-year historical median, which sits at 29.4 times forward earnings.
And this compression is happening despite the fundamental business remaining incredibly strong.
Right.
I mean, Microsoft owns 21% of the entire global cloud computing market and is projecting 16% annual earnings growth over the next 3 to 5 years.
Which is incredibly solid.
Then you look at Nvidia. It is trading at 23 times forward earnings. Its historical median is 45.3.
Wow.
It's practically cut in half relative to its historical premium, all as projecting 39.1% annual growth. They are still the absolute king of the AI build-out and have secured massive strategic investments in OpenAI and Anthropic.
Yeah, the fundamentals haven't changed.
And then there's Apple, which the sources highlight as the most nuanced of the group. Apple is trading at a premium compared to its peers, but it relies on its incredibly durable, locked-in ecosystem and its position as the ultimate consumer-facing layer of the AI revolution.
So the setup across all these megacaps is structurally identical.
How so?
The fundamental growth of their underlying businesses, the cloud migration, enterprise AI adoption, ecosystem lock-in, remains largely intact. But their stock prices have been compressed almost entirely by macroeconomic gravity.
Meaning the higher interest rates we just talked about.
Exactly. When the 10-year Treasury yield rises, the discount rate applied to future earnings rises.
Right.
A dollar earned by Microsoft 5 years from now is worth significantly less today if you can get a guaranteed 4.4% return from the U.S. government right now, risk-free.
So the multi-trillion-dollar question. Are the Magnificent Seven value traps right now? Like, are they cheap for a reason because the global economy is breaking down and they're just going to get cheaper? Or is this the ultimate generational catch-up opportunity if the war ends and interest rates eventually stabilize?
It depends entirely on the investor's time horizon and their capacity for pain.
Okay.
In the short term, If the military conflict escalates further and the Fed is forced to actually hike rates to combat oil inflation, these long-duration tech assets will absolutely face further multiple compression.
So they will drop more.
Right, they will be value traps for the next 6 to 12 months. However, if you zoom out to a 3 to 5 year horizon, the underlying secular trends have not slowed down.
Yeah.
The sources explicitly suggest that if you believe the fundamental thesis of the AI revolution, buying Nvidia at 23 times forward earnings is an incredibly compelling entry point.
That makes sense.
And Microsoft represents a massive catch-up opportunity simply because institutional capital was forced to liquidate it to raise cash during the broad market panic. The baby was thrown out with the bathwater.
It's a brutal tug-of-war between macroeconomic gravity and microeconomic fundamentals.
Perfectly said.
But while the mega caps are getting battered by interest rates, there's a subsector of tech that is absolutely thriving, seemingly immune to the macro environment. AI hardware winners.
Oh, yes.
We saw Micron's stock jump 9% in a single day, adding $43.8 billion in market cap. The driver is just an insatiable physical demand for memory chips to power AI.
But the truly fascinating play within the hardware space right now isn't the chips themselves, it's the optical stocks.
Yes, the sources specifically called out two companies, Lumentum and Coherent.
Right.
And the catalyst was a massive announcement. Nvidia is investing $2 billion directly into each of them.
Which is wild.
Why is Nvidia, a GPU design company, suddenly throwing billions of dollars at optical manufacturing companies?
It comes down to a fundamental law of physics that is currently bottlenecking the entire AI industry. Yes. Inside these massive warehouse-sized AI data centers, tens of thousands of GPUs need to communicate with each other at lightning speeds to train these large language models.
Right.
Traditionally, data centers use copper wiring to connect these servers. But as the computing power scales up exponentially, copper reaches its physical limit.
Let me guess. It gets too hot.
It generates a staggering amount of heat. It requires a massive amount of electrical power to push the signal, and it suffers from severe signal degradation over relatively short distances.
Basically, the plumbing is failing.
Exactly.
Yeah.
You physically cannot push enough data through copper wire fast enough to feed next-generation AI models without melting the infrastructure.
So the solution is light. Optical interconnect.
Precisely. Companies like Lumentum and Coherent manufacture the highly complex transceivers and components that convert electrical signals generated by the GPU into optical signals, essentially lasers that travel over fiber optic cables to the next server.
Oh.
Light moves faster, generates essentially zero heat, and consumes vastly less power. As data centers scale, they have hit the copper bottleneck. Optical interconnects are the only viable physical solution.
So Nvidia is just protecting its own product.
Right. NVIDIA recognizes that their $40,000 GPUs are useless if the data center plumbing can't handle the bandwidth.
Yeah.
So they're actively securing their own supply chain by directly capitalizing the optical manufacturers.
That is so smart.
This sector is massively outperforming the broader Nasdaq because it is the physical pick-and-shovel play of the AI gold rush.
I love that. It's not about the gold, it's about the plumbing that moves the gold.
Exactly.
Now, let's look at another area seeing massive moves driven by strategic infrastructure plays. Space, telecom, and M&A.
Yeah, this was interesting.
Globalstar, ticker symbol GSAT, their stock soared 24% to hit an 18-year high.
Achieving an 18-year high in the middle of a global market correction implies something structurally transformative is happening.
And that transformation is blockbuster M&A. Amazon is in advanced talks to acquire Globalstar for $9 billion.
Right. Now, on the surface, this looks strange. Why does Amazon want to buy a legacy satellite company? But looking at the sources, it's not about the physical satellites at all. It's about invisible real estate.
That is the perfect way to phrase it. It is a strategic land grab for spectrum.
Let's break down spectrum for the listener.
Sure.
Globalstar holds highly valuable global regulatory licenses for L-band and S-band radio spectrum. Now, why are those specific bands so important? These frequencies operate in, like, the Goldilocks zone for mobile communication.
Meaning what exactly?
Meaning they can punch right through bad weather, clouds, and rain, and they can connect directly to a tiny antenna inside a normal smartphone without requiring a massive satellite dish on your roof.
And Amazon desperately needs that capability.
Yes.
Amazon is building its own satellite internet constellation, formerly known as Project Kuiper, now referred to as Amazon Leo.
Right.
Their goal is to build a low Earth orbit network to directly challenge Elon Musk's SpaceX and their Starlink service. But Starlink already has a massive head start in physical deployment. They're already everywhere.
Exactly. To make Amazon Leo viable, to make it work seamlessly with everyday mobile devices on the ground, Amazon needs the legal right to broadcast on those specific weather-resistant frequencies globally.
So paying $9 billion for Globalstar isn't about buying their aging hardware in orbit. It's about buying the regulatory rights assigned to that company by international telecom agencies.
Yep.
It allows Amazon to integrate that specific spectrum into their new Amazon Leo infrastructure and mount a legitimate global threat to Starlink's monopoly.
It's literally a $9 billion chess move to secure the regulatory high ground in low Earth orbit.
Okay, so we've covered the winners, the optical cable solving the heat problem, the satellite spectrum land grabs.
Right.
But the sources also highlight some brutal laggards. Companies that are absolutely dying under the weight of this specific economic environment.
The other side of the coin.
Let's look at Tesla. Tesla dropped 5.42%. First quarter deliveries came in at 358,023 vehicles. Wall Street was expecting a range of roughly 365,000 to 370,000.
Missing delivery estimates by 10 or 15,000 units is painful, but the underlying metric hidden in the report is much more dangerous for their balance sheet.
The surplus.
Yes.
The sources explicitly note that Tesla's production output outpaced their actual deliveries by a massive margin, resulting in a 50,000 vehicle surplus for the first quarter.
50,000 cars just sitting on lots.
That's insane.
That represents billions of dollars of capital tied up in depreciating physical inventory.
Right.
In a high interest rate environment, carrying costs for inventory explode. Furthermore, the consumer is being crushed by the imported energy inflation we discussed earlier.
Which means they aren't buying cars.
Exactly. When grocery bills and gas prices spike, financing a $50,000 new electric vehicle at an 8% auto loan rate becomes mathematically impossible for the middle class. Tesla is feeling the direct physical impact of the macro environment.
And it's not just consumer discretionary products like cars and sneakers, though. We should mention the sources note Nike just suffered its second largest loss in 25 years.
Yeah, a rough quarter for them.
The stress of this macro environment is also fracturing the shadow banking sector. The sources brought up Blue Owl Capital. They are a massive player in the private credit market.
Huge play.
And they were hit with a staggering $5.4 billion in redemption requests in the first quarter alone. That represented 40.7% of its tech lending fund's total value.
This specific data point exposes a massive systemic risk regarding hidden liquidity stress.
How so?
We have to explain how private credit works. Over the last decade, when interest rates were near zero, private credit grew exponentially. These funds take money from institutional investors and lend it directly to private companies, often highly unprofitable tech startups that couldn't secure traditional bank loans.
But unlike a stock or a public bond, those private loans aren't easily tradable on an open exchange, right?
They are highly illiquid assets.
Yeah.
A typical private credit loan might have a 5 to 7 year lockup period. The fund cannot just ask the startup for the money back early. Now, look at the current environment. The investors who put their money into Blue Owl's fund are seeing extreme market volatility, a geopolitical crisis, and a severe correction in tech valuations.
So they panic.
They want their cash out. They submit redemption requests.
But the fund doesn't have the cash.
Exactly. When 40% of a fund's investors demand their money back simultaneously, but the fund's actual capital is locked up in 5-year illiquid loans to private software companies, you experience a massive duration mismatch.
The liabilities are immediate, but the assets cannot be liquidated.
This breaks the fund. It forces them to either halt redemptions, which creates panic, or sell off their best assets at fire sale prices just to raise cash. It exposes the inherent fragility of the private credit model in a high-stress, high-rate environment.
It's a classic run on the bank, but playing out in the unregulated, illiquid shadows of the private markets.
Perfectly stated.
Okay, to round out our analysis of individual sectors, there is one area being radically reshaped not just by macro forces, but by direct political intervention: pharma and tariffs.
Yeah, this is a big shift.
President Trump is formally proposing 100% tariffs on imported branded pharmaceuticals, a 100% tax.
The strategic goal of that policy is explicit and aggressive. It is designed to force the immediate onshoring of critical drug manufacturing back to the United States.
So they want the factories here.
Yes. It is utilizing trade policy to enforce a national security imperative. The administration views reliance on foreign supply chains for life-saving medication as an unacceptable strategic vulnerability.
And the market is adapting to this forced rotation immediately. Look at AbbVie. They reached a massive deal with the Trump administration to invest $100 billion into U.S. domestic manufacturing facilities in exchange for commitments to lower specific drug prices.
That is a staggering amount of capital expenditure.
It really is. But the market rewarded them for securing their position in this new domestic fortress. They beat Q2 2025 EPS expectations, coming in at $2.97.
If you take a step back and synthesize all of these idiosyncratic moves, Nvidia capitalizing optical cable manufacturers, Amazon buying satellite spectrum to bypass terrestrial networks, Tesla and Nike struggling to find consumers, and AbbVie spending billions to build physical factories in the U.S., what is the undeniable underlying theme?
Well, it's a massive structural rotation of capital. It's not just a sector rotation, it's a philosophical rotation.
It is the defining transition of this decade.
Yeah.
Institutional capital is violently fleeing consumer discretionary sectors. If a business model relies on a middle-class consumer having discretionary income to buy a new EV or expensive sneakers, investors are liquidating that position.
So where is the money going?
Where is that capital seeking refuge?
Sure.
It is pouring into hard physical infrastructure and strategic resilience. It's going into the optical plumbing of AI data centers. It's going into sovereign satellite spectrum, and it's going into onshored pharmaceutical manufacturing. The market is aggressively transitioning from valuing digital, consumer-driven growth to valuing physical, sovereign resilience. We are watching the real-time pricing of a war economy.
That is a profound realization. We aren't just seeing a temporary dip, we are witnessing a structural rewiring of what the global financial system values.
Absolutely.
And those idiosyncratic Stark moves don't happen in a vacuum. They are entirely dictated by the bedrock assets underlying the entire system.
Right, the macro foundation.
So for part 3 of our deep dive, we have to look at the foundation: commodities, bonds, and crypto. And we have to start at the absolute center of the geopolitical storm: oil.
Oil is the fulcrum. Every other asset class is currently balancing on the price of a single barrel of crude.
And the numbers are terrifying. Over the last week, WTI crude, the U.S. benchmark, jumped above $141 a barrel.
Which is high.
But Brent crude, the international benchmark, spiked even harder, briefly touching $141 a barrel. To put that in perspective, $141 a barrel is the highest level since the peak of the 2008 global financial crisis.
We have to understand the physical mechanics of why the price is accelerating so rapidly, beyond just the theoretical closure of the Strait of Hormuz.
Okay, let's break it down.
The United States government has been aggressively utilizing the Strategic Petroleum Reserve, the SPR, to artificially suppress domestic gas prices by flooding the market with emergency inventory.
Right.
However, the sources note a critical threshold.
Right.
These SPR releases are nearing total physical exhaustion by mid-April.
The emergency safety net is just gone. The U.S. can no longer manipulate the supply side to lower prices.
Exactly. And concurrently, you have an absolute logistics nightmare unfolding on the oceans. The physical routing of global oil has been completely upended by the kinetic strikes in the region.
The sources provided a stunning specific example of this. Massive supertankers are entirely abandoning traditional routes. A tanker moving oil from the UK to Australia is rerouting an extra 12,000 miles just to completely avoid conflict zones anywhere near the Middle East.
Think about the compounding cost multiplier of that single decision.
It's massive.
A maritime voyage that should take a few weeks now takes well over a month. The shipping company is paying the exorbitant daily charter rate for a massive vessel for double the time.
Right.
This ship is physically burning twice the bunker fuel just to make the extended trip. And insurance premiums, the cost to underwrite the cargo against acts of war, has skyrocketed for any vessel operating even tangentially near the Persian Gulf.
It all trickles down.
Every single one of those logistical friction costs is ultimately embedded into the final delivery price of that barrel of oil.
Now, it's not all doom and gloom for every single producer. The sources highlight that the Yanbu port in Saudi Arabia doubled its output to 5 million barrels a day.
Yeah, that's a key detail.
They are utilizing their internal east-west pipeline to bypass the Strait of Hormuz entirely, loading crude directly onto the Red Sea.
It acts as a vital safety valve for the global market. But we have to be realistic about the math. 5 million barrels moving through Yanbu does not fully replace the 8 million barrel deficit created by the strait's closure, especially considering that Red Sea shipping lanes face their own asymmetric drone threats.
Exactly.
But the most important takeaway for the listener regarding this oil shock isn't just about shipping routes. It's about what $141 Brent crude fundamentally does to the U.S. economy.
You mentioned a historical correlation earlier in our discussion.
Yes. There is a near-perfect historical correlation between U.S. oil prices and the U.S. Consumer Price Index, or CPI inflation.
Okay.
Oil is the foundational input cost for literally the entire physical economy. It is the raw material for the plastics used in medical devices. It is the jet fuel for global logistics. It is the diesel powering the trucks that deliver produce to your local grocery store.
Everything.
A sustained energy shock of this magnitude guarantees that headline inflation will remain incredibly sticky and likely accelerate. It completely undermines the Federal Reserve's multi-year fight against inflation.
Which brings us to an asset that traditionally thrives on high inflation and geopolitical fear, gold.
Right.
But gold has acted incredibly strange, almost broken, over the last week.
Gold behaved entirely counterintuitively to traditional macroeconomic models. It requires a deeper explanation.
Let's trace its path. Early in the week, when peace hopes were rising on those White House whispers, gold surged. It went from $4,200 an ounce up to $4,785 an ounce.
Which made sense at the time.
But then, Wednesday night happened. President Trump delivers his primetime address, vows to hit Iran extremely hard, effectively guaranteeing a longer war and more energy-driven inflation.
Right.
According to every textbook, gold should have skyrocketed to $5,000 on that news. Instead, it stunned the market by dropping over $200 an ounce, violently snapping a 4-day winning streak. It's like gold tripped over its own shoelaces right when it was supposed to win the marathon. Why did that happen?
It comes down to a concept known as the dollar milkshake theory and the absolute dominance of the U.S. dollar in times of acute existential global panic.
Explain the dollar milkshake theory. I love this concept.
It's a great visual. Imagine the global economy is a giant milkshake of capital.
Okay.
When the realization hit on Wednesday night that a major, protracted regional war was unavoidable, global capital panicked. Institutions, sovereign wealth funds, and algorithms immediately sought the ultimate, most liquid safe haven on Earth.
Which is the dollar.
Exactly. They don't buy physical gold bars, they buy U.S. dollars, often in the form of short-term U.S. Treasury bills. As the entire world sucks up U.S. dollars like a straw in a milkshake, the value of the dollar surges relative to every other currency.
And because gold is priced in U.S. dollars globally.
Exactly. When the denominator of the U.S. dollar gets significantly stronger, the price of the numerator gold mathematically must fall.
Oh, that makes perfect sense.
The strength of the dollar simply crushed the dollar-denominated price of gold. It couldn't overcome the gravity of the currency it's priced in. Furthermore, we are operating in a war economy. Sovereign nations sometimes need hard, immediate capital to fund operations or stabilize their own collapsing currencies.
Which explains the data point regarding Turkey.
Yes.
The sources note that Turkey abruptly liquidated 120 tons of their sovereign gold reserves. That is nearly $20 billion worth of physical gold dumped onto the market.
When a central bank needs immediate dollar liquidity, they sell their gold reserves.
Right.
When $20 billion of physical supply hits the market simultaneously with a surging U.S. dollar, the price of the metal collapses entirely, regardless of the prevailing inflation narrative. The demand for the dollar supersedes the traditional inflation hedge function of gold.
That is fascinating. The dollar is so overwhelmingly strong as a safe haven that it actually breaks the traditional utility of gold.
It does.
Now let's move from the broken hedge to the ultimate macroeconomic predictor, the bond market. Specifically, the recession signal.
The bond market is generally considered the smartest money in the global financial system. It dictates the cost of capital for the entire world. And right now, it is sending deeply conflicting signals.
We saw the 10-year Treasury yield push up above 4.3 your time, briefly touching 4.4%.
The Federal Reserve has kept short-term interest rates incredibly high to fight inflation, causing the inversion. However, at the exact same time, the U.S. federal government is engaging in astronomical deficit spending.
So the government is pumping money in.
They are pouring hundreds of billions of dollars directly into defense contractors to replenish munitions. They're utilizing the CHIPS Act to forcibly onshore semiconductor manufacturing. They're incentivizing pharma companies like AbbVie with massive subsidies to build domestic factories.
So the government is acting as the lender and spender of last resort. The government is artificially stimulating the physical economy while the Federal Reserve tries to cool it down with interest rates.
It is a massive macroeconomic contradiction.
Yeah.
The Federal Reserve is pulling the emergency brake, while the U.S. Treasury is pushing the accelerator through the floorboard. This staggering influx of government capital might actually prevent a traditional broad-based recession, rendering the historically flawless yield curve indicator temporarily moot. We are operating in entirely uncharted macroeconomic territory.
Uncharted territory indeed. And speaking of assets struggling to find their identity in uncharted waters, let's look at the final piece of our puzzle, crypto.
Ah, yes. The risk-on reality check.
Exactly. Bitcoin ended the first quarter of 2026 down 22%. When the initial kinetic military strikes hit and the strait closed, Bitcoin violently plunged down to $60,000. Now, it recently bounced back to $71,890, but our sources are very explicit on how to interpret this price action.
It is absolutely vital not to misinterpret that recent bounce as fundamental strength.
The analysis states this is purely a technical bounce. Let's explain that.
Sure.
It was driven primarily by a short squeeze. Similar to what we saw in the equity markets earlier in the week, traders heavily utilizing leverage to bet against Bitcoin were paying massive premiums, negative funding rates to hold those short positions.
Right.
When the price ticked up slightly, they were forced to buy back in to cover their losses, causing a rapid artificial spike to 71K. There was also some speculative trading surrounding the U.S. Clarity Act. But fundamentally, structurally, the overarching narrative of crypto has been shattered.
For the better part of a decade, the crypto community fiercely debated the core identity of Bitcoin.
Yes, the big debate.
Was it a high-beta technology stock, or was it digital gold, an uncorrelated, sovereign, safe haven asset that would protect your purchasing power during a systemic geopolitical crisis?
And the escalation of the Iran war settled that debate definitively.
It did. When the missiles actually started flying and the Strait of Hormuz functionally closed, global capital fled to the U.S. dollar.
Like we just talked about.
Right. Physical gold initially surged before the dollar crushed it, but Bitcoin plummeted synchronously with the riskiest, most speculative tech stocks on the Nasdaq.
It dumped with tech.
It proved, in real time, under extreme pressure, that institutional algorithms trade Bitcoin purely as a high-beta, high-risk equity proxy. When genuine existential fear hits the market, capital immediately abandons the digital scarcity of Bitcoin for the absolute state-backed safety of the U.S. dollar. The digital gold narrative failed its ultimate stress test.
And the technical setup for Bitcoin looks incredibly precarious right now. The courses note that if that psychological $60,000 floor breaks, technical trading models predict a rapid, aggressive plunge down to the $50,000 level, which is a huge drop.
We even saw Standard Chartered, which has historically been one of the most vocally bullish traditional financial institutions on crypto, slash their 2026 price target in half, dropping it from $300,000 down to $150,000.
That's a brutal revision.
And to add insult to macro injury, the sector is dealing with massive structural security headwinds. The sources highlight the Drift DeFi platform.
Drift is a decentralized finance platform, essentially an unregulated crypto exchange operating via smart contracts.
And it was just hacked by North Korean state-sponsored actors for $280 million.
Ouch.
When you combine a failing macro narrative with constant massive security breaches by hostile nation-states, it creates a brutal environment for any risk-on asset.
It perfectly reinforces the overarching theme we discussed during the equities segment.
Yeah.
In a highly inflationary war economy, institutional capital ruthlessly prioritizes physical utility, strategic resilience, and immediate risk-free yield over digital speculation.
We have covered an immense amount of ground today.
We really have. We started with the ticking clock of a geopolitical deadline threatening the Strait of Hormuz. We traced the algorithmic chaos of short-covering rallies. We exposed the hidden liquidity traps buried in shadow banking and private credit. And we analyzed the complete physical rewiring of global energy routes and semiconductor supply chains.
It's all connected.
It is. If there is one defining theme to take away from this deep dive into the source material, it is that we are actively, painfully navigating a generational transition.
A total paradigm shift.
We are moving decisively away from the low interest rate digital growth economy that defined the 2010s, and we are entering a physical, highly constrained inflationary war economy. Capital is rotating away from consumer convenience and into hard assets, infrastructure, and sovereign resilience.
And navigating that transition requires acknowledging that the old models are broken. The historical correlations like gold acting as a perfect inflation hedge, or an inverted yield curve guaranteeing an immediate recession, or Bitcoin acting as a digital safe haven might be temporarily, or perhaps permanently, broken by the sheer force of government intervention and geopolitical conflict.
The diagnostic X-ray machine is broken. We are operating in the muddy waters. Now, before we sign off, I need to explicitly remind you, the listener, The financial markets are incredibly volatile, especially right now.
Extremely volatile.
This deep dive is for informational and educational purposes only. Do not make investment or trading decisions based solely on what you hear on a deep dive. You must strictly do your own thorough research, understand the mechanics of what you are buying, and consult with a certified financial professional before putting your hard-earned capital at risk.
The stakes in this specific macroeconomic environment are simply too high for anything less than rigorous due diligence.
I want to leave you with a final building thought, something to consider as you watch the news this week. We have spent an hour today talking about how companies and markets are adapting to these immediate violent shocks.
Right.
But think about the long-term structural implications of what we are witnessing. If a localized regional conflict in the Middle East can completely rewire the global shipping map overnight, bankrupt shipping companies, and force the rapid trillion-dollar onshoring of tech and pharmaceutical supply chains back to the United States, what does this fundamentally mean for the future of globalization itself?
That's the big question.
Are we currently witnessing the permanent end of the hyper-efficient, just-in-time global supply chain that made everything so cheap over the last 30 years? And if so, are we replacing it with a massive, inefficient, just-in-case fortress economy where economic efficiency is permanently sacrificed on the altar of national security? And if that is the new reality, who ultimately pays the price for that security?
That is the defining macroeconomic and geopolitical question of the decade.
It really is. Thank you for joining us on this deep dive into the muddy waters. We'll be back next time to see where the currents take us.